Welcome. My name is Jason Payan, and I'm a CPA in Las Vegas, Nevada. I would like to briefly discuss with you today how to quickly tell if you will have to report taxable income on the short sale or foreclosure of your rental property. The Internal Revenue Code is very complex, and you will want to discuss your individual situation with your tax advisor. There are a few key considerations you will want to factor in when making your decision. The tax code treats a rental property just like a business asset. Generally, this treatment is favorable. However, proper consideration must be given to depreciation. When you short sell or foreclose on a property, you will get a Form 1099. That will report to you the amount of debt the bank has forgiven. Generally, the amount reported on the Form 1099 will be considered rental income, which will be taxable at your ordinary tax rates. A rental will not qualify for the Debt Relief Act, as discussed in the clip on primary residences. Since the tax code treats a rental property like a business asset, you will be allowed to deduct the loss on the sale of the property. Generally, this will mean that the income reported to you on Form 1099 can be directly offset against the loss that you sustain on the short sale or the foreclosure. This may mean that you will have no taxable income as a consequence of this transaction. As I mentioned earlier, proper consideration should be given to the effects of depreciation when going through a short sale or foreclosure of a rental property. Each year that you own a rental property, the IRS will allow you to claim a depreciation deduction. This means that each year you are writing off a portion of that property. Over time, these deductions can add up to be quite a lot. Anytime you sell a property, whether it's a short sale or a traditional sale, the IRS requires that you pay tax on the depreciation that you have already taken, and all of the depreciation deductions unwind. Sometimes this is referred to as depreciation recapture. When you short sell or foreclose on a rental property, the effects of depreciation recapture are much more apparent. In a traditional sale, you generally end up with cash at the end of the transaction, and you can easily pay the tax due to the depreciation recapture. However, in a short sale, you do not end up with any cash at the end of a transaction, and you still have to pay tax that is resulting from the depreciation recapture. If you have a rental property and you claimed a depreciation on your tax returns, you will need to get a copy of the depreciation schedules from your prior tax returns in order to determine how much depreciation was claimed. We ask that you obtain these schedules before calling our office with any questions or before any consultation. Unfortunately, we will not be able to advise you without this information. Some other factors that may affect the amount of depreciation recapture you must recognize are: 1. How long has the property been a rental? 2. How much down payment did you put on the property? And 3. Did you ever refinance the property and pull cash out, even if it was to invest in other properties? All of these things will affect the amount of depreciation recapture you must report at the conclusion of a short sale or foreclosure. In conclusion, a short sale or foreclosure of a rental property will generally result in additional taxable income to the extent that depreciation was claimed in prior years. If you would like to speak to one of our CPAs about your specific situation, please feel free to give us a call at area code 702-233-9526. Thank you.